Hi, everyone. This is our second Alpha Planning podcast segment. I'm Aaron, and I'm with Jeff, as always. And today's topic is on portfolio rebalancing. It's a common area that causes people some stress and discontent when it comes to managing a market portfolio. So, Jeff, the first question that's come up today is, can you speak on why you feel it's important to rebalance a portfolio consistently?
Yeah, rebalancing is something that is one of those things like that you can really do that should not cost a lot or be hard to do, but so few people do it. And what I mean by this is that when you typically buy a mutual fund or portfolio, invest in a portfolio with especially a commission broker, you're getting into it with some proportion of bonds to stock. And let's use the simplest example, a 50-50 balanced portfolio that is half bonds and half stock. Well, say you start that way day one. But what happens is, Aaron, is that over time, usually, of course, the equity side will grow. So that 50-50 is not going to stay 50-50 for very long. It's one of the sides is going to grow compared to the other, even if the other stays flat. So,
can you explain, just for the people that don't know, what is a 50-50 portfolio?
The 50-50 portfolio, once again, is half bonds and half stocks. So, but what happens is that if your portfolio over time can become a 70% stock, 30% bonds because of time and because it was never rebalanced. But what does all of this really mean to you or to the investor is that your portfolio has a whole heck of a lot more risk, which means it's a much bumpier ride, throughout, that might not be something that'll add to your contentment. And people can get stressed out, especially during big market surprises that they're, when the markets may melt down. They will always have those periods that happen periodically. But the reason is they're worse because people do not do this rebalancing. Mm-hmm. As opposed to our solutions, they do have a self-rebalancing so that you never go more than, if you have this example of a 50-50, half bonds, half stocks, it's never going to be more disproportionate than 45-55.
Mm-hmm. Can you speak on for people that aren't with us, that aren't clients that are familiar with that?
Sure.
People that employer plans, maybe they're limited to only being able to rebalance once a year. Do they have a choice? Or
most 401s, people can rebalance pretty often. It's just that they really aren't professionals and they don't really know what to do. So one of the things that we do with people, because this is a great need for folks, so many people have 401ks, 403Bs, and the other employer-sponsored plans, simple IRAs, things like that have no real consistent help. So we plugged into a specific thing that Aaron's actually spearheading this for our firm. It's called RMS, and what they do is for very, very low cost, they will go in and rebalance your portfolio in the beginning and then ongoing periodically based upon price movements. Just so that you keep your portfolio, your 401k or whatever your other employer plans
403B or 457 as well.
Yeah, and just this way you keep them consistent without them becoming bigger risk monsters, because that's what happens. Because the bonds aren't going to grow. Bonds just produce income, and they're not as volatile as stocks. Mm-hmm. But they still also have their risks. That's another topic for another day.
We talked a little bit on the last podcast about finding the right advisor and feeling comfortable with it. We talked about the struggle that a self-investor, someone that's managed their own assets their entire life, how tough that is on them.
Right.
So what do you think, or why do you think the self-investor has a more difficult time rebalancing their portfolio than someone that gives their trust to an advisor?
Well, I know for many reasons, but the primary reason I know that is because when I was learning, I was one of those people. So I know exactly how it feels. And I understand exactly the managing with just yourself or just with one person making decisions, even when to rebalance or whatever, is not really a reliable type of situation. It's not really one, because the human elements, your ego or your fear or whatever drives you, we're all human, we can't escape that. And the reason why our solutions work better is because it's not done by one person. It's not based upon emotion. It's based upon price movements. So when that 50-50 becomes a 60, it won't reach a 60-40 because it'll be rebalanced before then. And what that really does, folks, and this is kind of intricate, but this is the only way to buy low and sell high consistently, and that can never be done by singular human beings or even groups. It just has to be done based upon price over a long period of time, and that's how it happens.
Yeah, it seems we found that people have a sentimental value of holding on to a particular stock. Or
you know what? I want to mention something else on the rebalancing. ETFs, for those of you who may not be familiar with, they are exchange-traded funds. They rebalance, or what's called reconstitute, only once every 12 months. And that is actually where the tracking error comes in with those. So our structured investment system is far superior to even what I like. ETFs are far better than regular mutual funds. But when they do that, they have a lot of liability, because when an ETF has to do their to match the index that they're, whatever it is that they're tracking, they are removing companies that everybody else knows have been downgraded, so they're selling them over a period of time. They can't sell it all in one day, so they're losing more and more and more. So that is reflected in the returns of the ETFs too.
Sure. That's good insight.
Sorry, this is so technical. I really try not to do that.
Well, to maybe remove the technical, on the last question, this is actually the first prospective client that was going through our engagement process. The beginning of our process had this question. And on a personal level, let's pretend for a second I'm the client, and you've built my financial plan for me. And I have a portfolio that's in the market. How often should I be reevaluating it or looking at it without feeling consumed or stressed by
if you're doing it yourself, if you are managing it yourself, you mean?
We're correct.
Okay. Well, I would definitely look at it every quarter. That's probably almost too much. Most of the tracking and stuff that I've seen over the 2.5 decades of looking at these returns and being involved in this business, we find that rebalancing too often does not help. Often people mistake just doing something as a way of dealing with the stress of insecurity, of knowing, like, I got to do something, my account's gone down, or this is happening in the news, or whatever the case may be. And it's that emotion that is the killer, and it's why you need a good advisor coach. But if you're doing it alone, by yourself, I would not rebalance more than once every year.
I know people get uncomfortable with, I think most people understand the market's going to go up and it's going to go down. You don't know exactly when or how much.
Like it only when it's up.
But what would you say for the people that are trying to feel comfortable with whether you rebalance it or not? Maybe this is more of a psychological question.
Yeah, okay.
But how would you be able to make sure that they're comfortable with those downswings? You talked about a 50-50 portfolio. How does somebody land on a particular portfolio allocation?
Well,
like
because as Aaron may know the answer to this question, of course, but we're doing this video for all of you. But it's essentially, why do we do that?
Well,
you know what I'm saying?
I didn't want to answer my own question.
That's okay. I'm just saying, why do we do that?
Well, it comes down to the risk assessment that
exactly
is what someone's comfortable with.
Right.
How they want to be invested.
Right. What we do is a very expensive risk analysis on the early stages of our series of appointments that you do, getting your answers, first. We do that with every couple, and it's a way to see, first of all, how you're currently invested, how risky and bumpy of a ride is it. Okay, on a range of a scale of 1 to 100. Okay, 100 being the most risky, 1 being the least risky. Where do your current investments fall, and then where do the two of you, if you're married, where do you fall on your risk? Because very often we find here, don't we, that there's a big difference. I mean, only occasionally they're very close, but there's a big difference often of how people are invested versus what they're comfortable with. And it might be either way. It doesn't have to always be that they're invested riskier. Sometimes they can be invested even more conservative, right?
Yeah, definitely.
More conservative than even need to be. They're losing a little of buying power over time too. So that's one of the things to consider.
Great. Well, that's all we have time for today. Again, if you want to subscribe to our YouTube channel, you can click the link at the top of our website on the homepage, alphaplanners.com. And if you have anybody that's interested in learning a little bit more general information, please pass the link along to them. And we'll see you next time.
Absolutely. And folks, I just want to finish by saying I know that I still mentioned some things that might be confusing to you. If you need any help on sorting any of that stuff out, please feel free to call us at one of our offices, and we'll be happy to try to sort it out for you.
Sounds good. Take care, guys.